Welcome to Your Money, Your Goals, a financial empowerment toolkit for social service programs. This is a webinar training designed for financial empowerment trainers to help prepare them to train potential users of Your Money, Your Goals, case managers and other staff from social service agencies and other organizations that work with individuals and families with low income or limited resources. This is webinar 3, using the tools, an explanation of how the tools are covered in the training. If you are viewing this webinar, you've probably already viewed the first two installments. Webinar 1, which was getting to know your money, your goals, an overview of the CFPB toolkit. Webinar 2, which was really an overview of the training. And now we're actually going to be moving into using the tools, an explanation of how the tools are covered in the training as well as the toolkit. As has already been covered in the other two trainings you've viewed, the purpose of this training is to provide you with an orientation to your money, your goals, the CFPB's Financial Empowerment Toolkit, to provide you with an overview of the training for case managers and other frontline nonprofit staff, and finally, to provide you with the tools, knowledge, and confidence to provide this training to your constituency or in your community. The objectives for this webinar are the same as they were for the other two, but they're of course worth mentioning. So by the end of this entire webinar series, including the one you're viewing today, you'll be able to describe the key functions of the CFPB and its rationale for developing your money, your goals. You already have a great sense of this probably. You'll also be able to define financial empowerment and differentiate it from other terms used, such as financial capability, financial education, and financial literacy. You'll be able to describe or explain the overall organization and content of your money, your goals. And this was, as you remember, the key focus of the first webinar. You'll also be able to listen and describe your responsibilities as a trainer for your money, your goals, something that we also covered in the first webinar. You will be able to explain the tools or resources you have to plan and implement the training, as well as the overall flow of the training, including key activities and methodologies used throughout the training. So that's really the objectives for the overall webinar series. Today we're really going to focus on what happens in each content module. This is something you may remember seeing from the last webinar. It's a snapshot of the overall flow of the training that you will be providing either to case managers or to the constituency that you're training. If you may recall, the training itself kicks off with an engaging opener activity called Money and Me. While it doesn't relate specifically to a module within the toolkit, it reflects a lot of the information that's covered in Module 4, which has to do with the emotional and cultural influences on financial decision making. You'll then move into an overview of the training and introductions. Again, not something that's covered in the toolkit itself, but an important part of any training. The rest of the training actually pretty much follows the toolkit in the order that it's presented. And what we're really going to be focusing on today is starting with assessing the situation and starting the conversation, all the way through to protecting consumer rights. So we're going to begin with Module 2, Assessing the Situation. Module 2 contains 2 assessment tools. The first tool is the Financial Empowerment Self-Assessment for Case Managers. We know that some case managers find the idea of providing financial empowerment overwhelming. Many case managers feel like they just don't know enough about it. The truth is, no one knows everything there is to know about financial empowerment. Since it covers such a wide range of topics, it can be hard to know where to start if you do want to learn more. Identifying what you know as well as what you don't can be a place to start. First, they may see they know more than they think they know. And second, they will find areas where they could benefit from a little bit more information or know-how. In the training, you'll ask the participants to complete the Financial Empowerment Self-Assessment, which has 3 sections. Then you'll review the answers with them and have them in pairs discuss the reflection questions that you can see on the slide before you. You should note that the answer key to the self-assessment is actually immediately following the tool in the toolkit. Be sure to ask participants to not look ahead when completing Assessment 1. Here is an excerpt of the first section of the Case Manager Self-Assessment, which includes knowledge-based questions. The case managers will be asked to respond true or false to a series of statements. The next section of the Financial Empowerment Self-Assessment actually has case managers rank how they feel about different aspects of financial empowerment. So for example, the first statement says, I am satisfied with the amount of money I save. They would then rank that as does not apply or strongly disagree, disagree, agree, or strongly agree. This is the third and final section of the Case Manager Self-Assessment, and it basically asks case managers and other frontline nonprofit staff taking this self-assessment to think about their experience with different financial products, services, and situations. The second assessment tool in Module 2 is the Client Goals and Financial Situation Assessment. Rather than presenting on this tool in the context of the training, you'll run a role play. You'll have participants get into groups of 3. Each will select a role. One role will be the client, and that person will pretend that they are a client in the context of a case management meeting. The second role is that of the case manager. Their job is really to start a discussion with the client, kind of following the client's lead, and then introduce the assessment tool when appropriate. The third role is that of the observer, and they'll watch the discussion and take notes using a form or questions that you provide. Here are the questions that you might post for the observer or turn into a form that they can use during the observation of the role play itself. This is an excerpt of the actual client goals and financial situation assessment, and you can see it's designed to be very simple in terms of the responses, even though the responses give you a lot of information. So for example, the first question, do you have financial goals and know how much money you need to reach them? Yes, no, or I don't know. Are you in danger of losing your housing or car because you cannot make payments? Yes, no, or I don't know. Using the responses provided by a client as well as the answer key, a case manager or other nonprofit staff using this tool can figure out which module or tool to target to start out with. So for example, if someone answered no or I don't know to do you have financial goals and know how much money you need to reach them, they could go straight to module 6. If, for example, looking at question number 5, which asks, do you have money set aside to cover emergencies or unexpected expenses? If they answer no or I don't know, they can start with module 7, which is saving for the unexpected, emergencies and goals, or go to module 13, which focuses on financial products and services. So that's really how the assessment tool is set up. Based on the answer, you know where it is to kind of start with different clients based on the responses that they provide to the assessment. Because there are other strategies for bringing up the financial empowerment topic with clients besides the assessment, there are 2 options for continuing this dialogue in the context of the training. One is to have tables brainstorm specific opportunities for beginning the financial empowerment conversation with clients. The other is actually to act out a skit using the scripts that are provided in Module 3 and having participants react to those skits. So again, there are 2 different options for continuing this conversation of how do you bring up financial empowerment when working with clients in the context of case management. Now we're going to turn to the content modules, and we're going to start with Module 6, which is setting goals. Setting goals is actually the shortest section of the toolkit as well as the shortest section of the training itself. To begin with, you want to just talk about the reason for goal setting in the context of a financial empowerment toolkit. And of course, goals are all about helping participants or clients work towards making a better future. They can help individuals, clients prioritize how money is spent so that it goes towards the things that really matter. Goals, when they're set, especially using the SMART goal framework, can help individuals track their progress towards getting the things they want. And of course, it just gives a sense of pride when you achieve things that you set out to achieve. As was just mentioned, the SMART goal framework is used in this module of the toolkit. SMART means that the goal itself is written in a way that is specific. A specific goal has a much greater chance of being met than a general goal. Measurable, which means that someone should be able to track their progress towards meeting the goal. Able to be reached. Relevant, which is a goal that matters to the individual writing it, as well as time framed. And this just means that a goal has a clearly defined deadline. Another thing that you'll teach in the context of the training is how case managers can help clients figure out how much money to set aside each week for goals that require money. And this is a very simple calculation. It's just the total amount needed to reach a goal, which in some cases may require some research, divided by the number of weeks to reach that goal. So that's just counting from now until the deadline that's written in the goal to reach that goal. Divide that, and that's the amount to set aside each week. The reason it's each week rather than each month is that many people with limited resources actually think about their money on a day-to-day or week-to-week basis as opposed to month-to-month, and also because a lot of people get paid on a weekly basis. And finally, so that this calculation works nicely with the cash flow, which really looks at budgeting on a week-to-week basis as well. In addition to having a form for writing out the goals and ensuring that they're SMART goals and calculating the amount to set aside, there's also an action plan included with this tool in Module 6. And it's really taking the goal and then breaking it down into small steps that someone can achieve, as well as the resources they need to achieve each step, the date to complete each step, and when to complete. And so when all the steps are taken and if they're all achieved as is planned, the goal should be reached. So for example, say my goal is I want to pay my bills on time every month starting August 1st. Assuming that lack of money is not the primary reason my bills are not being paid on time, here are some steps that I might sketch out in my action plan. First would be to collect my credit card statements, my loan payment statements, my utility bills, phone bills, and documentation of other payments that I make each month. So that would be step 1. Step 2 would be to actually go through those and highlight payment amounts and due dates. Step 3 would be to maybe go into one of the other modules and grab the bill paying calendar tool and set that up so that I have a visual as to when my bills are due and how much are due. The 4th would be to consider using automatic payment methods for some recurring bills or online bill payment, and so on. So that's just really about taking a goal and breaking it down into steps, and it's a really important part of the goal setting tool as well as module. The next module is Module 7, Saving for the Unexpected, Emergencies, and Goals. You want to make sure that you take time to acknowledge at the outset of this section of the training that for some very low-income clients, saving may not be their main goal. But you also want to emphasize that saving, even in small amounts, can matter and make a big difference for clients. So you're actually going to kick this particular section off with a discussion about what savings is. So you'll ask participants to share their own definition of savings, and then you'll share the definition of savings using this slide. After that, you'll actually ask participants list examples of unexpected expenses or emergencies in small groups on a flip chart. After they brainstorm for a few minutes, you're going to have them go back and circle those that they think could be handled with $1,000 or less. You'll ask them to post their flip charts and share what they found cumulatively, and then you'll be able to see how many different kinds of emergencies or unexpected expenses can actually be managed with $1,000. This is really to contrast this idea of emergency savings with the conventional wisdom that advocates 3 to 6 months worth of living expenses. For many people, that feels like an impossible goal, so they don't even try. $500 to $1,000 does seem possible for many more people. They can imagine it, and it can make a very, very big difference. And as will be demonstrated by this activity, you'll see that a lot of different emergencies or unexpected expenses can really be handled by $1,000. By working towards that, rather than this large goal right at the beginning, people will be able to create some emergency savings and then be able to hopefully avoid taking on debt to cover some of these expenses or emergencies when they arise. Once you go through that activity, you'll actually then define what an emergency fund or rainy day fund is, and then talk about its importance in a savings plan as well as an overall financial plan. Not only is it there to help people cover expenses as they come up, especially those that are unanticipated, but it's there to help prevent people from going into debt. In the training, there's another activity to help people further understand the benefits of emergency savings, and that's the cost to replace spark plugs on your car example. It's in the toolkit as well as in the training as already mentioned. What you'll ask participants to do in pairs is look at the information contained in this chart and then identify both the monetary and non-monetary costs and benefits of each approach to covering this unexpected or emergency expense. So all of that important introduction information leads to the first tool, which is the savings plan. The savings plan is a document that actually outlines the reasons that someone is saving, the amounts they need to save, how they're going to find that money to save, as well as where they're going to put that savings, a place that is hopefully safe and secure. Here's an excerpt of the savings plan with an example filled in. One really important concept to talk about with case managers is what to do with money that's not spent in the effort to generate savings. Not spending does not necessarily generate savings. It's just money that hasn't been spent. In order for it to actually be savings, that money that hasn't been spent has to be moved into either a jar or a shoebox or a savings account or even onto a prepaid debit card to count as savings. Often financial education curriculum emphasize the need to cut back to generate savings, but don't talk about that important step of taking that money and putting it somewhere to actually set it aside so it doesn't get spent on other things. That's how savings is generated. Another concept you'll want to talk about in tandem with the savings plan is the earned income tax credit. This tax credit can be used to jumpstart savings. It's actually a benefit for working people who have low to moderate income. It reduces the amount of federal income tax owed and may result in a tax refund. And in fact, it does result in a tax refund for many people, and it's one that they count on. This tax refund is based on income and filing status, and information about it is outlined in the toolkit. The Benefits and Asset Limits tool is another tool that has been provided in this module of the toolkit. The reason this tool has been provided is to make sure that people are aware of the fact that there may be asset limits when they are trying to save money. Asset limits are thresholds of the amount of assets or including savings that someone can have without jeopardizing the benefits they receive. While this information was accurate when the toolkit was published, it's important to review it with case managers and add to it any information that they may have from their day-to-day work as case managers. The third tool, Finding a Safe Place for Savings, has clients examine the benefits and risks of different places to put savings. A benefit is something that provides an individual with an advantage, while a risk is any chance for loss. Rather than coming out and saying that everyone should put their savings in a bank or credit union account, this tool has people examine different options for putting their savings, whether it's in a jar or under a mattress, or in an account at a bank or credit union, or on a prepaid debit card, or with a family member or friend. All are examined from the perspective of benefit and risk. Other information you'll cover in the context of training associated with Module 7 are direct deposit and savings. In fact, there's a section in the toolkit in Module 7 about this, as well as bank and credit union insurance. This is obviously included to help people understand that their money is safe and secure in an institution that is insured either by the FDIC or the NCUA, as well as banking history reports. A lot of people are familiar with check systems. There are other banking history reports, and these can sometimes be a barrier to opening something like a savings account at a bank or credit union. Now we're going to move on to Module 8, which is Managing Income and Benefits. In the training, you'll actually kick off this module with a discussion about income, regular income versus irregular income versus seasonal income versus income that's a one-time occurrence, much like the earned income tax credit that we just talked about. You'll also talk a little bit about benefits and how they're different from income but should be counted as a financial resource coming into the household and something that should be planned with and budgeted for, as well as wage garnishments. Wage garnishments are rights given to creditors, including the U.S. government, to collect money directly out of someone's paycheck. This can generally only happen with a court order, but there are some exceptions, and you'll use the information that's contained in the toolkit itself to explain wage garnishments to the case managers that you're training. The first tool that you'll talk about, not surprisingly, is something called an income tracker. And this is really just a way to help people understand and categorize as well as document their income on a weekly basis, not only from their job, which they probably are pretty clearly aware of, but other sources of income that they may have. It's pretty common in families with limited resources that they have multiple sources of income and financial resources that make a patchwork of income coming into the household. And the job of this tool is really to sort of break that out and help people understand when that income comes in and how much they can expect from week to week. The next tool in this module is called Increasing Cash and Financial Resources. And rather than just presenting this tool, you'll ask the participants to analyze this tool in pairs. What you'll ask them to do is circle those strategies they think are potentially feasible for their clients, identify strategies that are missing, as well as think about strategies that are listed that may not be feasible for their clients. It's important to acknowledge that some strategies may not be applicable for the people that they serve, and to focus on those that may be feasible for the clients that they serve. Here you can actually see an excerpt from tool number 2, Increasing Cash and Financial Resources. And this is, again, just an excerpt, so there's a lot more to this tool. For example, there are one-time activities listed, such as holding a yard sale or garage sale or selling items online or claiming tax credits. There are examples of ways to increase regular income, such as seeking a raise or additional hours at a current job, or seeking opportunities for training or education that would increase wages at current job, and so on. The next tool, or tool 3, actually is called Understanding the Risks and Benefits of Cash, Paychecks, Direct Deposit, Payroll Cards, and EBT. And it really looks at the different risks and benefits associated with the different ways that someone can receive income. Here's an excerpt of that tool, and you can see cash is actually the example. So the definition of cash is included, as well as the benefits associated with it. It's accepted everywhere, and it's not subject to garnishment or the other collection, as well as the risks. It could be lost or stolen. Some find it easier to spend cash when they have cash in hand. It's more difficult to track for personal budgeting or tax purposes, and not all bill payments can be made in cash. And then the thing that really makes it a tool, besides the simplicity of the information and its accessibility, is the check boxes. This is a good option for me, and where can I get more information, or this is not a good option for me. The next module is Module 9, Paying Bills and Other Expenses. Module 9 actually begins with that Vote with Your Body exercise that we talked about in the last webinar. To begin with, you'll actually define what spending is and then differentiate needs, wants, and obligations. Prior to this actual section of the training, you're going to hang up 3 signs around the room. You're going to want them close but not too close. One sign will say need, one sign will say want, and one sign will say obligation. And then you're going to actually read off a list of different things that people could spend their money on, such as paper towels, or a cell phone with data plan, or getting your hair cut professionally. And after each example of an expense that you read, you'll ask people to go and stand underneath, whether or not they believe that that is a need, a want, or an obligation. And then you'll facilitate a discussion, because people will be split on some things. Some people will see, for example, paper towels as a need, others will see it as a want. And then the purpose of the discussion is really to help case managers understand the point very clearly that needs and wants are subjective to a certain extent. And because this is a financial empowerment curriculum, we want to honor those things that sometimes people identify as needs, even if from where we sit they may not be. The first tool in this module is the spending tracker. What you see before you is a list of the categories that are used on this tool. It's actually half of the list, and it continues on the next slide. This tool is set up to be an easy way to track spending on a day-to-day basis and includes categories such as savings, debt payments, housing, utilities, household supplies and expenses, groceries, eating out, which includes meals and beverages. The categories continue on and look at transportation, healthcare, personal care, child care and school-related expenses, entertainment, court-ordered obligations, as well as gifts, donation, and other expenses, which is really the catch-all category. In addition to tracking spending on a daily basis, participants or clients should be encouraged to do this over a week, a couple of weeks, or even a month. Following the actual tracking, there's then an analysis section of the tool so that people can look at where they're spending and where they might want to make some changes. The next tool in this section is the bill paying calendar, and it's meant to be a visual reinforcement of when bills are due. This avoids late fees, cancellations, as well as reestablishment of service fees, all of which can be very, very expensive. So just as in the last module, there was a tool for increasing cash and other financial resources, this module has the sister tool, Strategies for Cutting Expenses, as well as the same process for reviewing it. In pairs, you'll ask participants, the case managers that you're training, to review the tool by thinking about their clients and circling strategies that they think are most feasible and identifying strategies that are missing, as well as those they think might not be very relevant for the people that they serve. Here is an excerpt of that tool, so you can see the first category is cutting back on regular or recurring expenses, such as television, internet, phone, cell phone plan. And this tool actually goes on for 3 pages. So rather than having people just come up with off the top of their heads or by looking just only at their spending tracker ways to cut back, this tool is designed to help them get a jump start on thinking about different creative ways they may be able to cut expenses. The final tool in this module has to do with when cash is short, prioritizing bills and other spending. And rather than starting off with a list of how to do that, there's an exercise that has case managers, the people that you're training, examine the consequences of skipping bills. Sometimes people have to make hard choices about missing payments altogether or being late in order to make ends meet. But it's also important for them to be aware of the consequences of those actions. And so what you'll do is have your participants divide up into 4 groups. If you have a really large group, you'll have 1 or 2 or 3 group 1s, 1 or 2 or 3 group 2s, etc. And you'll basically have them examine the consequences of, for example, paying rent late versus the consequences of missing multiple rent payments, the consequences of making a car payment late versus the consequences of missing multiple car payments, and so on. And this is really a lead-in into the actual tool itself. Tool 4, Prioritizing Bills and Spending, has been included to help clients develop a short-term plan for when their income cannot cover all of their needs, obligations, and wants during the month. People often pay the creditor that demands payment the loudest or most frequently. If and only if clients cannot pay all of their bills, they need to come up with short-term plans to avoid the long-term consequences associated with not paying some bills or expenses that result in losing a job, their shelter, key assets, or having legal consequences of not paying obligations, especially those that have been court-ordered. This tool has been designed to help case managers ask questions to help clients take those first steps to building that plan. And that brings us to Module 10, Managing Cash Flow. This particular section of the training begins with a discussion about what a cash flow budget is. And you'll basically ask participants to share what their definition of a cash flow is. And it's basically a projection of how you'll get and use cash and other financial resources. You'll also ask them to contrast cash flow to a regular monthly static budget by asking, how is a cash flow budget different. The basic difference boils down to timing, the timing of income and spending, and this is really key. The reason this is important is that it's often the timing of money, not only the amount, but the timing of money that can sometimes cause people to fall short in a month, and that can be masked in a monthly budget, which is why a cash flow budget can be so useful, especially with people with limited financial resources. You'll then go through the steps of creating a cash flow. The first thing will be keeping track of both income and spending for a week, 2 weeks, or a month. And we've actually just covered 2 tools to help you do that from the previous 2 modules. Then you'll analyze your spending using Tool 1, the spending tracker from Module 9. Finally, you'll use this information to create a cash flow budget, either using Tool 1, the cash flow budget template, which is a spreadsheet format, or Tool 2, which is the cash flow calendar. You can see that a cash flow budget begins with a beginning balance for the week. The beginning balance for a week is actually the ending balance from the previous week. Then it looks at all of the different cash or other financial resources anticipated for that particular week, and you end up with a total sources of cash and other financial resources. Then we look at the spending or the expenses or the bills that are due that particular week. That gives you the total uses of cash and other financial resources, and then when you subtract that from the total sources of cash and other financial resources, you get your ending balance for the week. So in this example, you can see that in week 1 that the individual is anticipated to be in balance and have a surplus of $142, which again is carried over and becomes the beginning balance for the next week. And in week 2, their budget is also in balance. To ensure people really master this concept of cash flow budgeting, because for many people it will be new, they're used to that static monthly budget format, we go with an example, and the example is a scenario around Raphael, who is a single parent with 2 children. You'll go through these particulars of his situation, and then you'll actually share with people the example cash flow. Ideally, you would print this out prior to the training so that each person or each team has a printed copy of the cash flow statement. The cash flow statement, the example of Raphael, is not in the toolkit. So here is the actual cash flow budget for Raphael. And you can see just quickly that there's some weeks that he actually runs out of money. When you actually do the scenario analysis or have the participants themselves do the scenario analysis, this is one of the things that they'll be discussing with their partner is what can Raphael do if he anticipates these shortages? What are some things that can be done to keep the cash flow from going so out of balance on some weeks? Here are the questions that you'll actually share to help the participants guide their cash flow analysis. After going through the scenario analysis, you'll basically share with people that when cash flows don't balance, there are basically 3 things that can be done. They can increase their sources of cash, income, and other financial resources. We've already talked about the tool that helps people identify different ways to do this. They can also find ways to decrease their spending or uses of cash and other financial resources. And again, in Module 9, there's a tool designed to help people think through this. The other strategy is to figure out ways to match the timing of sources and uses of income where possible, which isn't always possible, but sometimes it may be. And the third tool in this module looks at just that. Strategies for improving cash flow. The first group of strategies on smoothing out cash flow are really about timing. Specific strategies include negotiating new due dates, splitting a monthly payment into 2 smaller payments, or avoiding large lump sum or periodic payments by making monthly payments rather than quarterly or semi-annually. This may increase their cost, but it may make it more feasible in terms of covering that payment on a monthly basis. This again is just an excerpt of this checklist. There are many other strategies that case managers can look at with their clients if cash flow is an issue. The next module is one that case managers will probably find themselves referring to quite a bit, and that's dealing with debt. This section of the training actually starts with a facilitated discussion about what is debt. Debt is often conflated with the term credit, so you'll also talk about how debt is different from credit, as well as the differences between secured debt and unsecured debt. And of course, in the facilitator notes, all of this is spelled out very clearly in case you yourself aren't completely clear about those differences. This is all a lead into an activity, the good debt, bad debt activity, which uses the methodology stand up or sit down. Basically, you're going to want to start this section of the training off with an explanation that some people think about some debt as good debt and some people think about some debt as bad debt. The purpose of this activity is really to sort of challenge the common wisdom and really identify the fact that debt is debt. Debt is when you owe somebody money, and that there are bad aspects of all debt as well as good aspects of all debt. And I say that with quotations around good and bad. And so really that's the reason for doing this exercise. And so you'll basically, one at a time, show each one of these debts and have people stand up if they think that the debt is a bad debt, and stay seated if they think it's a good debt. And then after each one, you'll facilitate a discussion. Those that are standing up, why do you think this is a bad debt? If they're seated, why do you think this is a good debt? For example, loan from a family or family member or friend. A lot of people will identify this as being good debt. Why? Well, it will likely have flexible terms. It may be a low or no interest loan. Missed payments are not reported to a credit reporting agency. So those are all good aspects of that kind of loan. Well, there are some bad things. It can create family conflict or conflict with friends if that loan isn't paid as agreed or is never paid. And it also cannot be used to build credit history. So if it is a debt that you're on time with because you want to make sure that you're honoring a debt with a family member or friend, you're not in any way improving your credit history. So again, it's just designed to help people think about the conventional wisdom around good debt and bad debt and recognize the fact that debt is debt and it has different characteristics, some of which are positive, some of which are negative, and it's important for people to understand that. The first tool that you'll introduce in this section of the training is the debt management worksheet. And in this worksheet, people will basically account for all the debt that they have. This is something that they'll need to collect all of their bills for, get them all in one place in order to complete. And the worksheet itself basically has people list in table format the business person or organization they owe money to, the amount they owe, the amount of their monthly payment, as well as the interest rate they're paying and other important terms. This is just so that they have a realistic idea of the debt that they owe. The second tool in this particular section of the toolkit, as well as in the training that you'll introduce, is the debt to income worksheet. The debt to income ratio is basically a simple calculation that shows how much of your income is going towards paying debt. It's a good measure of how much income is basically obligated to debt. So for example, if a debt to income ratio comes out as 40%, that means that 40 cents out of every dollar earned is going to pay for debt, and that 60 cents is left over to pay for things like taxes, food, rent, gasoline, and so on. You'll explain how to calculate it, and it's really quite a simple calculation. The hardest thing is coming up with the total monthly debt payment, which is the amount of debt that someone pays per month. So it would be what the monthly auto loan payment is. It would be what the payment is to the credit card company each month. It would be what the monthly student loan payment is, all added together, and that's the total monthly debt payment, divided by gross income, not net income, but gross income. To help people understand the debt to income ratio a little bit better, there's an example provided in the training, not in the toolkit, but in the training. And this is the example. You'll have people, again, either with a partner or in groups of 3, calculate the debt to income ratio for Shauna, based on the information provided on the slide. And then they'll make a judgment as to whether or not they think she can afford this new loan, given her debt to income ratio. This is the slide that provides the analysis or interpretation of the debt to income ratio. This shows the level of debt that clients may want to consider as the maximum level to ensure that payments are sustainable for them. It's divided into renters and homeowners because renters don't have a mortgage and therefore don't have housing debt that homeowners do. So in other words, a renter may want to consider maintaining a debt to income ratio below 15 to 20% to ensure that their debt levels are sustainable. Tool 3 is the debt reduction worksheet, and there are 2 primary methods for reducing debt outlined in the debt reduction worksheet: the high interest rate method as well as the snowball method. And one of the things that the worksheet does is highlight the pros and cons of each. So the high interest rate method basically says if you are paying on all of your debts, if you have any money left over, put that to paying off the debt that has the highest interest rate first because you're paying a lot more for that debt. Versus the snowball method, which says you should identify the debt that has the smallest amount owed in total, irrespective of interest rate, and pay as much as you can to eliminate that debt as quickly as possible. Once that debt is paid off, you continue to make that payment, but obviously not to the creditor that you've already fulfilled your obligation with. You take that same payment and now you lump it in with the next smallest debt until that one is eliminated. And then you take that total payment and apply it to the next smallest debt. So you're basically creating a snowball running down the hill. It continually gets bigger, and you apply it to each debt as they get bigger. Tool 4 is the student loan debt tool, and it basically looks at the different kinds of student loans that are available, specifically federal student loans versus private student loans. And then it goes through an explanation of the different options for repaying student loans, as well as some of the key terminology around student loan debt. One of the things you'll want to be sure to highlight in this section of the training is the Paying for College tool on the CFPB's website. This tool provides information as well as resources and tools to help prospective students as well as current students research schools, fill out the FAFSA, choose a loan, compare financial aid packages and college costs across more than one school, manage money while in school, as well as, again, options for repaying student loans. If you have an internet connection where you're training, it would be great to pull this up during the training and actually explore the tool online with the case managers that you're training. There's another exercise for this section of the training, and it basically looks at not only the debt to income ratio, but strategy for debt reduction or elimination. And this is really meant to be sort of a capstone exercise around this debt module. Because there's so much information, the example actually goes over multiple slides, so you'll have to go over it with the case manager sort of slide by slide. Ideally, you would actually photocopy these slides and hand them out if you're going to choose to do this exercise with the case managers. The last tool in this module is When Debt Collectors Call, and it basically looks at your rights and responsibilities around debt collection. It also includes example letters to write to creditors or debt collectors, specifically asking them to verify or prove debt that's owed, or even to ask them to stop contacting you. The next module is Module 12, Understanding Credit Reports and Scores. The first thing you're actually going to do in this section of the training is define and differentiate the different sections of a credit report. One of the things to remind the case managers that you're training is that while formats vary among different credit reporting agencies or consumer reporting agencies more specifically, that they all have these 5 sections in common, even though they may show up in different orders within the credit reports or may be called slightly different things depending on the formats used. Within the toolkit, you'll actually see there's an example credit report, and it is a generic example. While it's based on some elements of all 3 major credit reporting agencies, it does not represent any one of them, and so it's meant, again, to just give practice in looking at the kind of information that's contained in a credit report. And to do this, rather than, again, just presenting or talking through the example credit report, you'll have them sort of go on a scavenger hunt into that credit report by finding the information that's listed on this slide within the example credit report. And of course, the examples are included in the facilitator instructions of the training slide deck that you'll receive. One of the things you'll want to be sure to cover with case managers is the reason that credit reports and scores are important, and that has to do with who actually uses them in decision-making with respect to consumers. So the first is that a bank or credit union will use them to decide whether or not to give someone a loan. A lender may also use them to decide what interest rate someone will pay for a loan if they are approved. A credit card company will use credit reports and scores to determine whether or not someone will get a credit card, and again, the rate they may pay. Other service providers like cell phone companies and utility companies may use them to screen people for deposit levels as well as cost of service. An insurance company may use reports and scores to determine whether to give someone insurance coverage and the rates they will actually pay for that coverage. A landlord may use reports and scores to determine whether or not to rent an apartment to somebody, and again, what level of security deposit may be charged. Finally, a potential employer may use reports to determine whether or not someone will get a job. I also want to cover the 3 major credit reporting agencies, Equifax, Experian, and TransUnion, as well as the way to get the free annual credit report as a result of the FACT Act at www.annualcreditreport.com. Be sure to inform the people that you're training of imposter websites. People get tripped up with imposter websites if they Google free credit report or free annual credit report. It's really important to go directly to this website. You'll also want to explain how people actually get their credit reports through this website, that it's not simply just pressing a button, that in fact you'll go to this website, you'll be asked to enter some personal information, and then you'll be asked to choose. Do you want your Equifax report, your Experian report, your TransUnion report? And then you'll have to go through the process for each of the credit reporting agencies separately to get the credit reports from them. So it's not a one-click process. You also want to explain that credit reports are generated from information that is provided to them by information furnishers. Information furnishers are all of the same organizations or businesses that use credit reports to make decisions. So banks, credit unions, credit card companies, the student loan providers are all organizations that provide information to credit reporting agencies, and it's that information that's used to actually create the credit reports. So the first tool is obviously going to be getting your credit reports and scores, and it's a step-by-step in, again, table format on how to order your credit report. And again, it's very straightforward and simple to follow, and there's also a recording section so that people can keep track of when they ordered the report and when they received it, because best practice is ordering and reviewing credit reports at least once a year from each of the 3 major credit reporting agencies: Equifax, Experian, and TransUnion. One of the things that will be really important in this section is to talk about how credit scores are created. And because there are multiple different credit scoring models out there, we chose to go ahead and have you focus on the FICO score because it's the one that's most commonly used between 85 and 90% of the time when it comes to decision making. And basically you'll use the notes from the facilitator instructions to explain the composition of the FICO score itself, which you can see in this pie graph in front of you. But there's much more explanation in the facilitator instructions themselves. So the tools in Module 12 are really meant to be used together. The first tool has to do with ordering credit reports and scores. The second tool, the credit report review checklist, will be used to actually review that credit report that's ordered. And finally, Tool 3 has steps and tips for improving credit reports and scores. The 13th module is evaluating financial service providers, products, and services. To be clear, the Financial Empowerment Toolkit does not focus on banks alone. It looks at financial service providers more generally. And you can see from this list that financial service providers are many. There are obviously banks and credit unions, but then there are department stores, automobile dealers, check cashers and payday lenders, online companies, mortgage companies, and so on. There are many different financial service providers that operate within our economy. And that's an important point for case managers to understand. The first tool in this section has to do with selecting a financial service provider, and it's actually something that you'll have the participants complete in the training. Rather than prescribing a specific financial product or service, the toolkit takes the approach of matching need or goal with financial product, service, and provider. And that's really the purpose of this tool. So as has been explained, this tool was designed to identify what the client wants or needs to do. And based on their response, they can begin to identify the product or service that meets their need, as well as where to get that product or service. This is the second part of Tool 1, and it's basically an answer key for the rankings that someone did in the first part. So for example, if someone ranked that they want a safe and secure place to keep their money, they would learn from this tool that a bank or credit union has savings accounts, checking accounts, or certificates of deposit as secure places to keep money. Or they could go to a retailer, check cashing store, or online to get a prepaid debit card, ideally one set up so that the individual funds are fully insured. This is a financial empowerment approach to financial products and services. It matches need with product and service with provider. The next tool basically has a list of all of the different financial products and services that are commonly available at banks and credit unions. And again, rather than present on this, you'll actually have people get into groups of 2, and you're going to give them a product or service explanation template, and they're going to fill it in using these instructions. Here's an example of what that template looks like. So they'll come up with a definition where someone can get that product or service, when someone would use this product or service, as well as the benefits and risks associated with it. They'll use information in the toolkit as well as from their own experience to fill this in. And once you give people about 5 to 10 minutes to complete their information template, each pair will then present their information to the entire group. So it's a teach back using these templates. The final tool in this section of the training is an opening an account checklist. And you'll actually kick off the introduction of this tool with a facilitated discussion about whether or not Anyone can open an account at a bank or credit union, as well as should everyone open an account at a bank or credit union. The first one is fact-based. Can anyone open an account? The answer is no. Someone may have a negative check systems rating, a poor credit report, or they may not have the money to open an account at a bank or credit union. Should everyone open an account at a bank or credit union will be an interesting discussion that will really help you understand some of the opinions of the case managers that you're training. The checklist itself then covers all of the things that are needed to actually open an account, including the types of identification banks and credit unions accept for opening accounts. The last module has to do with protecting consumer rights. The first tool in this section of the toolkit is identifying red flags. And the way you'll animate this in training is actually using skits. You'll actually have people act out different skits where they use some of the different red flags that someone may encounter with different financial products or service providers. And the group watching the skit will actually try to identify the red flags they're observing by actually using the tool. So this gets them familiar with the tool in a way that is hopefully fun and engaging. Here are some of the different red flags, for example, that could be used within a skit. And this is for skit 1, steering and coercing, prepayment penalties, and mandatory arbitration are examples. The second tool in this module of the toolkit is protecting your identity, and it has a checklist of all of the information as well as the documents that people should strive to protect. It also includes a list of the signs of identity theft. The next tool, or tool 3, is submitting a complaint to the CFPB. This slide shows the process that a complaint goes through when it is submitted to the CFPB. Consumers can submit complaints about financial products, services, or providers. They can do this either online or by calling a specially designated number from the CFPB. One thing important to note about this process is that an individual can submit a complaint on behalf of someone else. This is what the actual interface looks like on the CFPB website, and again you can see that you can actually submit a complaint on behalf of oneself or on behalf of someone else. The fourth tool in this section is a summary of key consumer protection laws. And again, rather than a presentation, groups are invited to actually read about and then summarize back to the large group a presentation about the particular law or regulation that the group has been assigned, as well as why that particular law matters to the clients that they serve. One of the things I already mentioned in the earlier webinars is the resources available at the CFPB's website. So you'll want to go ahead and share this with the case managers throughout the training itself. It's actually listed in the toolkit multiple times, and again at the conclusion of the training, the general CFPB website as well as where to go for a complaint. The final thing that you'll do in the training is the closing activity as well as administration of the post-training assessment if that's something that you're choosing to do with your training. Again, the purpose of a closing activity is basically just to provide closure to a training. What we have provided is basically 2 questions that you can ask people to respond to using round-robin format, which means that you go around the room in an organized fashion, giving everybody the opportunity to speak one more time. You can, of course, feel welcome to substitute your own closing activity at this point in the training. So now a congratulations are in order. You have not only completed webinar 3, using the tools, an explanation of how the tools are covered in the training, but you've actually completed the entire Your Money, Your Goals training for trainers. So now you're all set to go and train case managers in your community or your constituency on using Your Money, Your Goals.